I have a good friend who's a land flipper. I'll have to add that to his arsenal.
So I'm glad you brought up the F word, flipper.
Welcome to the Dynamis podcast, where we are all about unlocking a fruitful life, removing your limiting beliefs, and getting to the next level. My name is Tim Garul, and I'm stoked to grow on this journey with you. As David Geffen says, we are each the figment of our own imagination, and some people have the greater ability to imagine than others.
This is the Dynamis podcast, where we give you the strategies and tactics to become financially and philosophically free. My name is Tim Garul, and I've lost everything for standing up for what I believe in. And now I'm building a blueprint to give to you so that you can come on the journey with me to become financially free. In this episode, we are going to talk all things 1031, everything that we need to know about 1031 exchanges, the tax benefits, what to think about, things that you have never thought about, reverse 1031s, and most importantly, the value of partnering with an expert in the space to navigate when you are exchanging so that you don't make mistakes when you're doing these. These 1031 exchanges, they're somewhat ambiguous if you haven't done a lot of them. There are a lot of nuance. There's timelines that have to be met. And so today in the studio, I brought an expert, a 1031 consultant. His name is Kyle Williams, and just super stoked to have you today, Kyle. Welcome.
Yeah, thanks for having me, Tim. I'm super excited to do this with you.
Why don't you tell the audience a little bit about who you are and what it is that you do?
Yeah, so my name's Kyle Williams, as you mentioned. I oversee sales in the Northwest for Velocity 1031. We're a division of fintechs, which focuses on really a lot of DST, REIT, large commercial exchanges. In my role, again, sales, consulting, really I wear a bunch of different hats.
So just for everybody listening in the audience that's maybe never heard some of these terms that you're talking about, real quick, like REIT, DST, can you just give a basic breakdown of some of the terminology that you're talking about?
Yeah, so REITs are not exchangeable. A 1031 exchange is when someone sells an investment property and buys new investment property. But the key is that you have to be selling and buying real property. A REIT is not real property. And a lot of people, I've owned REITs, you probably own REITs. A lot of people have owned REITs and they're like, well, that's real estate. Kind of, but you don't actually own the real estate. You're investing in companies that invest in real estate, right? Whereas a DST, a Delaware Statutory Trust, that actually is exchangeable because you own the real estate. You might be a fractional owner, say 1.37% of a commercial property like an Amazon warehouse. You're just paying a trustee to manage it for you, but you actually own the property. So a lot of people compare DSTs to REITs. They're really not the same thing, but DSTs are exchangeable, REITs are not.
And also, like in a REIT, you don't actually own the physical real estate. You own a share of a company. It's like a publicly traded share, just like the stock market. That company happens to hold a large portfolio. You don't have a specific, address. Like when you invest in a real estate syndication, for example, you're investing in a particular address of that deal. In a REIT, you're buying a share of the company's value. So can you give us just a quick breakdown of what is a 1031 exchange and why do real estate investors need to be thinking about it?
Yeah, so 1031, it's part of the tax code. It's section code 1031, which is where we get 1031 from. But it really lays out the groundwork for you to sell investment property and use all the proceeds to reinvest in a new investment property, but most importantly, defer all the federal taxes as well.
Okay. And so this is like huge. That right there, what you just said, is the deferment of the federal taxes is substantial. Correct. And the reason is, as investors, what is our biggest expense? It's taxes. Most people say, they're going to come up with a number of things, capital expenditures, who knows what. But at the end of the day, it's taxes. And if Americans were forced to siphon off a portion of their income and hold it into a savings account that they held in their hand instead of, just sending it to the IRS every single month automatically out of their paycheck or, on a plan with their CPA, if they physically saw the amount of taxes that they're paying, it would blow their minds. Most Americans have like no concept of how much taxes they're paying. And here's where it gets really, really powerful on the 1031 exchange front. And this is why I called you here today and why I think it's so powerful, especially to all these investors who are trying to compound that snowball, the velocity of money. We want to keep as much money as we have in our pocket as possible. And then we want to place that, we want to deploy that capital so it compounds and grows exponentially. And if we're paying taxes above and beyond what we should be or could be paying taxes, it's limiting our redeployment of our funds. So what happens is you reach a certain maturity level in your portfolio where you start looking at your down leg. And when I mean down leg, it's your existing portfolio that you have today, right? Maybe you started with some, onesie, twosies, single family, mom and pop, whatever. And all of a sudden the market has gone up. You've been investing consistently for 10 years and you look at your portfolio and you have a substantial amount of equity. We just went through this 2020 to 2024 today. I mean, we saw huge increases. Okay, so now we're looking at the return on equity. As we become more savvy investors, we're looking and we're thinking about the deployment of our capital. Are we getting the highest and best return? Because as investors, we need to be thinking of our portfolio like a chessboard. How can we move pieces to play the game better and better and better? And if we have lazy or dead money in our portfolio, maybe we have like a 40% loan to value on a piece of property that's got almost $1 million in equity, which is totally possible in the Seattle area, for example. And we're making $1,000 a month in cash flow. Well, when you look on the cash on cash return and compare it and contrast it to like a return on equity, well, hold on a second. There's a delta there. We may make a decision, hey, if I took all this equity and redeployed it, I could get substantially greater returns by redeploying it into maybe multiple more properties.
Sure.
And so the key here, and then I'm going to step out of the way and let you take over. The key here is that if we were to sell that property, we're paying what? Taxes.
Yep.
We're paying capital gains. And if we were wanting to sell, pay the taxes and go redeploy, it is completely hamstringing the amount that we can reinvest in the future to continue to compound and grow.
Yep.
And so the 1031 is this powerful tool that investors have that's available to us today. I don't know if it'll always be available. Maybe we could talk about that in the future, but it's this insanely powerful tool. It's this like steroid cheat code that investors can use to continue to grow their portfolio.
Yeah, you're exactly right. There's nothing else like it in the tax code. I've heard a lot of investors, people younger than us that have already built this huge portfolio of real estate. And they're like, 1031 is the greatest wealth building tool out there. That's what allowed me to buy and sell and grow my portfolio so quickly is doing 1031s. And I should say 1031s are not for flips, they're for long-term holds. But, some people, maybe invested for a couple years. And then like you mentioned, they may go into multiple properties. They may exchange geographically. I mean, any number of reasons would cause people to sell and buy. But most importantly, they're deferring all the federal taxes.
Yeah.
So when you don't pay federal taxes, your financial picture looks completely different at the end of the day.
Yeah. And I think right now we're stepping into this era where, we're kind of at a demographic shift generationally. Okay. The up and coming generations, Gen Z, Gen Alpha, which is crazy to say that, these are the up and coming generations, and millennials are kind of becoming like the elder generations,
Yep.
which is wild, when you really think about the context. Yep. But these younger generations that are coming up, they're really kind of being, I guess, influenced is the best word of, a lot of them are instant gratification. They're younger, they're not investing. If you look at just the data of younger generations investing actively today for retirement versus all of the generations that came before them, there's a huge, huge void. Okay.
Yeah.
And when we look at why is that, it's distrust of a system, right? There's a lot of reasons. They saw some, major economic, fumbling. I think they're buying into this narrative that, hey, there's not going to be enough for them. Social Security is going to run out.
Yep.
And essentially, where we are at right now is like millennials who really grabbed a hold of, for example, free information like Bigger Pockets, like all of these,
Yep.
social media.
Yep.
Those generations of investors, they're just now getting to a point where, hey, now we're starting to see that a lot of them are in a position to where it's time to exchange. And the thing about these exchanges is they're kind of ambiguous. There's not a ton of information. Like I could pull up 3 videos right now about how to invest in, infinite banking, right? With a cash value life insurance policy.
Sure.
I've never seen anything about 1031 exchanges, at least not to the depth and level of
Yep.
people breaking this concept down.
Yep.
So for me, I've been a buy and hold investor. My entire portfolio to date has been buy and hold. I've never exchanged. Never. And, I'm at a point now where it's like, okay, I need to start thinking about exchanging, I have no idea where to begin, you know?
So what you're saying is there's nothing wrong with it. What's crazy about real estate, and I've figured this out, is that so many investors, like, I'll meet investors and they have, 10 doors or 50 doors, whatever the case is, 8 doors. And the way they've made their money in real estate is completely different. Like, I always hear news stories and people are like, oh, you can't reinvent the wheel. In real estate, you can. Like, everyone's got a different strategy. That's what's so cool about, when I get to talk to these people. But you were saying buy and hold. Like, we'll do exchanges for, boomers, people that are, 60, 65 years old that have owned a multifamily building in Seattle that they bought 40 years ago for $200,000 and now it's worth, $8 million. So buy and hold, there's nothing wrong with buy and hold. And I think a lot of successful investors are buy and hold oriented as opposed to, always trying to look for the next step. It's like, it's kind of like day trading sometimes.
Yeah, for sure. I think there comes this breakover though, when you're looking at your portfolio and it does need to be rebalanced, right?
Correct.
And so, that's what I really want to talk to you about is I want to shine light. I was terrified about hard money until I started talking to some hard money lenders. And I was like, oh, I kind of peeked my head through the clouds. It's not so scary. I understand how to go get this debt, what the terms are, how to use it. So 1031 for me is kind of one of those ambiguous things. It's like, yeah, I probably should start rearranging my portfolio. I don't know where to start. And why I have you here today, and what I'm hoping that we can accomplish is that, we can leave a breadcrumb trail of actionable steps of, strategy, what we should be thinking about, where to start, what should I know, or any of the listeners who are in a similar situation, what should they know? A lot of the listeners are in similar, demographic. They're investors, business owners, and they're on the journey. They're on the journey of, financial freedom. And so I guess if we just were to start at square one, what do we need to know about 1031? I mean, how soon before we make a decision about selling or, or any of that, I don't even know where to start the process of an exchange,
Yeah. So 1031 is relatively straightforward. So our job is what's called a qualified intermediary, is to hold funds. So if I meet someone and they're like, what do you do? I say 1031s, inevitably they'll say, what is that? So it's hard to explain to people not in real estate or, even a real estate adjacent industry. So I just say it's kind of like escrow. When you sell a house and escrow holds your funds, that's kind of like what we do. And they're like, oh, okay, that makes sense. But with 1031s, like, that's really our job, is to hold funds for the duration of the 1031 exchange. We'll get into rules and stuff in a few minutes. But most importantly with a 1031 is like, you have to have a plan, right? So like, you would want to know what you're selling, what you're buying, why you're buying, all that stuff. So 1031 is kind of a last step in the process. Everything has to be set up before you close on your sale. But if you, Tim, were like, Kyle, where do I start with this 1031 thing? I would say, you need to figure out what your goals are, what you want to exchange into. Because if you just sell your property and do a 1031, then you're going to be scrambling to find something. And like, all this stuff has to be planned out. That's most important.
Yeah, I think and just as a general, for any audience member that's listening that doesn't understand the time parameters, I think maybe that's a good place to start. Why would they be scrambling? I think there's general knowledge, you got like, hey man, you got 45 days to find somewhere to put that money. But what is that? How do we quantify the 45 days?
Yeah. So after you close on your sale, funds will go to us. We'll hold the funds for up to 45 days if no properties are identified. If you do identify properties, which means you have to let us know in writing by day 45 what you're going to purchase. There's no extensions outside of federally declared disasters. So essentially we would tell people there's really no extensions. So 45 days after you close on the sale of your property, you need to know what you're going to purchase. Ultimately, you have 180 days to close on that new purchase, but that's generally not a problem for people. It's the 45 days in finding properties, especially around here, Pierce, King, Snohomish, really anywhere in Washington, even in Eastern Washington, properties, there's not a lot of inventory. Properties can go quickly. So 45 days can be a scramble for people if they're not prepared.
So when you say 45 days, when does that first day start?
So close of escrow on your sale. So the day you close that transaction, that sale, that's day 0.
Okay.
So on and so forth.
Okay. And then 45 days, is that 45 days to get under contract or 45 days to close?
Great question. So 45 days means you have to let us know in writing what you're going to purchase. You don't have to be under contract, but that's smart to do. Because if you identify 123 Main Street, Puyallup, Washington, on day 43, on day 48, there's a good chance that might be sold to someone else or pulled off the market or something, so you want to be under contract if you can. And being under contract doesn't guarantee a purchase, but it moves your odds up immensely.
So technically speaking, on day 45, if I email you, Kyle, this is the property, I have a verbal agreement with the seller, we're going to write this contract up tonight and go mutual, on day 45, that would meet the guideline?
Yeah, there's a little more to identification. Like we'd want you to sign and date an identification form, which basically just lists the address. But yeah, in principle, yes, that's exactly what would happen.
And then is there a timeline on escrow and closing after that?
Yeah, so after that, you have an additional 135 days to close, which means 180 in total.
Okay.
So basically, from the time you close on your sale, you have 6 months to close on your purchase. Most times, most escrows are going to be, approximately 30-day closes. So if you get under contract on day 30, for example, and you have a 30-day close, within 60 days of closing on your sale, you're going to close on your purchase. I'd say that's probably about average, right? But if you want to buy a new build or something, and that's not going to be ready for 4.5 months, you have that full 180 days to actually close on that purchase.
Okay. Yeah. And I guess there's no special exceptions on new builds or developments or anything like that.
Correct. Yeah. There's absolutely no extensions outside of federally declared disasters. And we won't get into this, but there's some caveats that you basically have to be directly affected by the federally declared disaster. So we would tell people there's essentially no extensions. It doesn't matter if you're under contract on day 45 and then on day 50, the seller wants to pull the property or cancel the contract or whatever. It's you may have legal recourse there, but from a 1031 perspective, the IRS would have no sympathy for you, even though it's not your fault.
Right. So when I decide, okay, I'm going to sell, so you want to have this planned out. Okay, I'm going to sell. So I kind of want to be looking with, hey, this is what I want to exchange into. You want the puzzle pieces to line up. I can't just get under contract without notifying an agency or a service that we are going to 1031. Is that correct? This has to be kind of planned out. How far in advance does that have to?
For the purchase or the sale?
For the both. Let's say I'm selling my home here.
Yeah. What's great is that in Washington, in the standard MLS paperwork, that real estate agents and brokers use. There's called a Form 21. It's an initial purchase and sale agreement. That already includes a 1031 language in there that has to be disclosed to the other party. And everyone signs that whether it's a 1031 or not. It's part of that, at the beginning of a contract, it lists all the different caveats of the contract. 1031 exchange is actually in there. So assuming you're working with a licensed agent or broker, it's already going to be in there. Attorneys would disclose it as well. The only time I've made sure a client would add it is if a client wants to do a FSBO, a for sale by owner, and they create their own contract. I remember we had one guy, I don't know, year, 2, 3 years ago. And he wanted me to look over this contract he created. I was like, I can't do that. You need an attorney. He's like, oh, that costs money. And it was a FSBO guy. And he found it wasn't even a real estate contract. He found a contract on the internet. He just searched legal contract, and title and escrow took it, and I guess it passed muster, but it's that's another thing. It's there's nothing wrong if you want to do this yourself, but agents and brokers and professionals provide a valuable service.
I agree.
Because you can get yourself into trouble very, very quickly. Work with an attorney, work with a professional of some sort.
Yeah. I mean, how soon do I need to call you and let you know that, hey, Kyle, I am exchanging,
So ideally, once you're under contract, that's when we can set up the exchange, because we'll work with title and escrow at that point. I would tell people too, if you're a week out from closing, that's fine. It just doesn't give us as much time to dot I's and cross T's. As long as you haven't closed, it's not too late. We'll get people that, I've had many of these over the years where someone will call at 9:30 in the morning. They're like, hey, we're at, WFG title and escrow. We're going to close today, this morning. Can we still set up a 1031 exchange? It's yeah, we can do that. We call it a rush. We'll get it set up, but we can't dot I's and cross T's. So I don't really even know what you're selling at that point. Yeah. We can have a quick conversation, but maybe it's a second home that wouldn't qualify. And in which case it's you can't even exchange this. So we would encourage people sooner rather than later in the process.
So I know that your explanation was really good. Is you're this third party escrow who holds the funds the proceeds from the sale. You're insulating them from the seller paying taxes on that and then allowing them to exchange. So you're kind of like this conduit, this third party. I guess, do you have any say over what buyers and sellers are allowed to exchange into? Like, are you guiding them in that way, or is that really more of like a tax issue?
Great question. So yeah, probably the most common question I get is for guidance on property purchases. And we're a legally disinterested party. So like, anyone on our staff that's an attorney or CPA or financial advisor or anything can't guide the clients. Your broker can't guide the clients. This is strictly for a CPA because there's a lot of gray area. Like the IRS has never defined what an investment property held with long-term intent is or means, right? So, most times I can tell clients are like, oh yeah, we want to buy a condo and just rent it out. We're not going to use it. It's just going to be a rental on, Airbnb or whatever. It's like, yeah, that's fine. Buying land is fine. Commercial, fine, all that stuff. But if it's like, oh, it's going to be a vacation property, but, our kid may use it for like a few weeks out of the year. We'd say like, well, a couple weeks is probably max, but talk to your CPA. Like you can get into gray areas with 1031s pretty quickly. So most of the time I can tell clients, this is a definitive yes or no, but there's plenty of times where I'm like, hey, you need to call your CPA because, you may ask 100 CPAs this question and 50 may say one thing, 50 may say the other. So it's not for me to make a case to the IRS if you get audited. Yeah, no, for sure. Yeah, I was trying to figure out, okay, who do I need to assemble on my team to make sure that we're navigating this process effectively, right? Yep.
So then I guess that leads me to my next question or line of questioning, and that's, when we do exchange, what can we exchange into? Like I know the language of like-kind properties.
Yep. Yeah, like-kind confuses a lot of people because they're like, hey, I'm selling land. I've heard about this like-kind thing. Yeah, I guess this means I have to buy land, but I don't want to buy land. It's like, well, you don't have to. Like-kind means any type of real property held for business or investment use. So like you can really get off into the weeds on what like-kind investment properties are, like air rights, cell phone towers, rentals, commercial, land, boat slips. One thing that pops up around here in, I should say, the Puget Sound area are houseboats. And I've had a number of these over the years where a client will call and say, hey, I want to exchange, 102 East Lake Ave, number B, Seattle, Washington. And it's like, I think it's a condo and then it's a houseboat. It's like, you can't exchange that because it's not real property. They're like, what do you mean? I've had a renter in there for 10 years. It's a rental. It's like, it's not real property. It's the slip itself. That's what's taxed as real property. That's what's exchangeable.
So you could exchange for another slip.
You could exchange for a commercial building if you want to.
Oh, no kidding.
Yep, because all those things are investment property. So we'll see people, like one of the common things that we'll see people do is they'll sell land and put that stagnant equity to work and buy like a duplex. So landowners all have the same story, and there's nothing wrong with owning land, but landowners all have the same story. Oh, I've owned this land for 30 or 40 years, and if you or I were to approach them and say, hey, have you thought about selling this? You could get a great price. They'll say, what am I going to do? Sell this and pay taxes and buy something just expensive? You're like, no, put the stagnant equity to work. You're not even getting depreciation because it's land. That's like the number one tax benefit to even owning investment real estate. Exchange that into this duplex where it's kicking off, $5,200 a month in income, and you get the tax benefit of depreciation. They're like, are you serious? I can do that and not pay taxes?
Yeah,
absolutely.
That's a really good point. I have a good friend who's a land flipper, and I'll have to add that to his arsenal of closing techniques of tactics, I guess.
So I'm glad you brought up the F word, flipper. Yeah. Flippers don't qualify for 1031 exchanges.
But the sellers who have held that land.
Correct.
Right? So as he's trying to close them, he could say, listen, you could put this to work and start getting depreciation off of this as well.
Exactly. I know that there's agents and brokers, there's title reps, there's a lot of people in the real estate industry that have figured this out, kind of like what your friend is doing, and approached landowners and said, hey, I'm not making you an offer. I'm telling you, here's what you can do.
Yeah.
You can exchange into something that actually produces cash flow, something where you can get depreciation. So like your friend, if someone doesn't want to sell, there's a good chance that landowner has never even heard of a 1031 and has no idea that they can do that.
Yeah. It's just another feather in the cap, you know. Flippers, they don't get to benefit from the tax benefit, the tax-free benefit, because it's active income. There's no long-term tenants in there for them. It's an active income generator. Is that correct?
Yeah. So the IRS has said that with 1031 exchanges, you want to hold with long-term intent for business or investment use. Well, what does that mean? It hasn't been defined. There's really three answers here. If you talk to CPAs, some will say, listen, if you're producing rental income, it doesn't really matter how long you hold it, or you put your business in there. It could be 8 or 9 months. Some CPAs would say, well, it's clear the IRS, when they say long-term, they mean 1 year or greater. And there's there's actually a revenue procedure I'm not going to get into that says, before you use it personally, it needs to be investment property for 2 years. So some CPAs will say, hold it for 2 years before you sell and do a 1031 exchange.
Oh, I see. So like a primary residence would need to be converted into an investment property for 2 years before
Correct.
Technically you could benefit from the exchange.
Correct. So if clients approach me or, they call and have questions and they're like, oh yeah, my wife and I have owned this rental for 20 years. That's fine. It's, we've held this rental for 8 months. Can we do an exchange? You need to get guidance from your CPA, because if it's an unsolicited offer, like you already had tenants in there, you just got an offer from a developer who's buying up the block and you can't say no to that. And it's like, yeah, it's probably fine, but you still want to consult your CPA. It's when they're flipping and they're like, oh yeah, we never collected income. We just kind of fix it up. And it's like, well, that's not going to work. There's no long-term intent there.
Yeah. So let's get back to like-kind exchanges. I just want to ask a few questions, I'm sure you get these all the time, but okay. So let's say I have, let's say I have a house with $1 million in equity in it. Okay. Easy. We'll start easy and we'll kind of work complicated. I could sell, notify you that I'm going to exchange, select the form, to disclose it. And then I would take those proceeds, you would hold those proceeds. Could I take that and buy, maybe 5 houses at a cheaper value and get 100% of the tax benefit in the exchange?
Oh, absolutely. And that's really been common since COVID. I mean, we've seen people exchange into one of 4 states, Tennessee, Texas, Florida, and Arizona. And, even some of those peripheral states like Alabama, for example, it's like, someone may find a portfolio of rentals of 8 rentals in Huntsville, Alabama for, $1 million. And they're like, I just sold this duplex in Bellevue for, $1.1 million. I'm going to own all these properties in Huntsville, Alabama because they're cash flowing, cap rate's so much better. So people do that because in the 1031, you really just want to do 2 things: buy for equal or greater value to what you sold for and reinvest all your proceeds. So if that's 1 property or like 5 in your example, absolutely.
So what happens if it's lesser value? Let's say I sell my home for, whatever, $1 million. Yep. I walk away with $500,000, but I buy a house that's $300,000 in Alabama. What happens that $200,000?
Well, so you would be taxed from $1 million down to $300,000 because you want to buy for equal or greater value to what you sold for. So if you buy down in value, you're taxed on that difference.
Okay, but if I bought multiple, then it would lump together.
Correct.
And increase the overall value.
Correct. And we would call that a partial exchange, and people do that. They're selling $1 million property, $1 million duplex in Bellevue or wherever. And they're like, hey, we found this we found a couple duplexes in Spanaway that cash flow really well, but it's only $800,000. Can we do that? Yeah, you'll just pay tax on that difference you bought down for and defer the rest. And some people may want to take money out.
Okay, can you back up here? When you say pay the tax that you bought down for, can you walk me through that?
Yeah, so if you sell for $1 million, you want to buy for $1 million and reinvest whatever proceeds come in. Let's say you only bought for $800,000. So you bought down for $200,000 in value. You're taxed on that $200,000.
Yeah, because the reason that you're paying taxes on it is because that $200,000 isn't going, it's just sitting. It's in your bank account.
Or you may invest all the proceeds and you're just buying down for $200,000. Because the IRS has said, listen, as long as you buy for equal or greater value and reinvest your proceeds into new investment property, that's basically what you want to do. So
you would be taxed on the value lesser than the new purchase price.
Correct. And people do that. It's super common, and we would never discourage anyone from doing that because, some people may just not want to put $1 million to work. They may find something awesome at 750 or 800,000. It's like, we'll do that. You're still going to have a small tax bill or whatever your tax bill is, but you'll defer the rest.
Or maybe you want to put a portion of it into the stock market, or maybe, maybe you want to pull cash out to fund your liquidity. You got to pay tax on the cash that you're keeping on hand, right?
Exactly. Yeah. We see that all the time. Hey, we're going to reinvest, all 1.4 million, but we want to take $50,000 out to pay off junior's college education. Can we do that? Yeah, that's fine.
So let's say that I sold a single family or, 3 single families, whatever, and now I want to go buy a commercial property, a multifamily. Is that a like kind? Yep. Can I do that?
Yep, absolutely.
I can buy anything. I can buy, industrial, commercial, retail, as long as it's equal or greater value and it's real property.
And all proceeds are reinvested.
All proceeds are reinvested.
I mean, you could buy water rights in Wyoming if you want to.
You buy water rights.
Yeah.
And what about land? You could buy land. You can exchange out of real property and buy land.
Absolutely. So this is not a firm and fast rule, but you can essentially exchange into anything, any type of real property held for business or investment use, as long as it's not personal use or a flip. I mean, granted, so
if you bought a parcel of land, for example, and it was like the family's hunting ground, now that doesn't work, right?
Yeah, because you wouldn't buy from yourself.
But you could lease it out, and then you could rent it from yourself, right?
Well, so you probably want to talk to a tax fraud attorney about that. For sure. I'm just kidding. Yeah, I mean, you can theoretically use the investment property up to 14 days a year.
Okay.
And it's still investment property, assuming that you're collecting rental income and everything else.
Yeah.
And it's not like a second home or anything. So for like we've seen people do that. Like, oh yeah, we buy this, we buy 500 acres in Wyoming. And we want to go down there and hunt for,
a couple days
10 days a year. That's fine.
And you can use those funds tax-free to exchange.
Yeah.
Here's one. It gets real cold and rainy here in the wintertime. Maybe I want to sell my portfolio, buy a beach house on, Florida, on Daytona Beach, for example.
Oh, yeah.
But I'll rent it out all year long, as long as I don't exceed 14 days a year of use.
Yep. And so that's another. We've had people exchange into the Virgin Islands. You can exchange into any U.S. state or territory. Puerto Rico doesn't qualify, but Virgin Islands do. So we've had people do that. Or buy a place, overlooking the water in Hawaii. And they're like, oh, my spouse and I, we're going to go there for 10 days over Christmas. The rest of the year, it's going to be on, VRBO or whatever.
Yeah.
That's fine.
Interesting. This is a powerful tool. You can use it for a lot of things.
You can use it for a lot. And then after 2 years, you can do with it whatever you want. And so we'll see people do that. Like, they may own a $3 or $4 million commercial building in Tacoma, right? And they've owned it forever. It's basically all equity at this point. And they're going to sell that and do an exchange into their, dream home on the golf course in Paradise Valley, their mansion that they've always wanted. It's going to be a VRBO property for a couple of years. And after that, it's going to be their forever home. And then they're going to pass it on to their heirs tax-free.
Interesting.
Never paid taxes on it.
Interesting.
Yeah, pretty cool, right?
How do they pass that on? Do they have to put it in like a trust or something like that?
No. I mean, they can pass on a little over $12 million per spouse to their heirs tax-free at the federal level. Yeah, Washington State has its own weird little estate tax. It starts at like 10%. But at the federal level, between 2 spouses, it's about $25 million they can pass on federally tax-free.
So if we exchanged into the dream beach house or whatever, we rent it out for 2 years. 2 years after that, then I decide, you know what, I want to live in this as my primary now. I'd be able to do so?
Absolutely.
Interesting. Okay. Let's talk about water rights. And I did not plan to talk about water rights at all.
Okay.
But you brought it up and I'm interested. So I could exchange real property and purchase water rights for equal or greater value?
Absolutely.
Can you tell, how? Tell me, why? Why would I do that? What could I do with those water rights? Can I sell water rights for?
Sure.
And benefit from the exchange and the real property?
Absolutely. Yeah, water rights generally, like the exchange I've done, they go through attorneys, but water rights are very valuable, right? Like this is probably another podcast discussion for another time. But like Michael Burry, the Big Short guy, he's been talking about water for a long time. A lot of people really think water's like, the next oil. Like, water rights are very valuable, and they are. But water rights are also very expensive. So you'll see someone in, Douglas County over in Eastern Washington or Grant County in Ephrata, and, they sell water rights for $4 million. And then they want to exchange that and they want to buy, commercial buildings or what have you. or maybe someone's selling over here and looking for water rights in Wyoming because of the growth there, and they want to get ahead of it. They can do that.
So they're essentially exchanging, sitting on water rights and hoping that they appreciate as the population grows, and then somebody buys them or pays them for the water access in the future.
Yeah. So I don't think most people are generally land banking or water banking in that sense. They're going to lease the water rights out to like farmers and stuff. It's just, it's probably more the hope that it will appreciate over time.
Yeah. Man, that is really, really interesting. So, okay, then conversely, so we have a 1031. Can you talk me through what is a reverse 1031?
Good question. Reverse 1031, everything just flips around. So instead of closing on your sale and having 180 days to close on your purchase, you close on your purchase first, then you have 180 days to close on your sale.
And then how soon in that process do I need to notify you? Like, hey, I want to do a reverse 1031.
Yeah. So like I said, in a normal 1031, a traditional forward 1031, whatever you want to call it, we can theoretically set it up the same day as the closing, as long as they haven't closed yet. Obviously, we like more time. In the reverse exchange,
as long as you haven't closed on the purchase.
As long as you haven't closed on the sale.
So, on the sale. Yep. So after I've purchased, I don't need to tell you when I purchase.
Sorry, I got ahead of you a little bit. In the reverse exchange, you close on a purchase first. We would need to know at least a couple weeks before closing.
Yeah, that's what I'm asking you. Is on the purchase timeline, would you need to know before closing that I'm going to do a reverse?
Well before. Like at least a couple weeks. In a normal 1031, we could do it 2 hours before closing.
And that just ensures that I get the benefit of the 1031?
In a normal 1031, as I mentioned, we hold funds. In the reverse exchange, we actually have to take title to that property.
Oh, okay.
So we'll file an LLC with the state and actually take title to that property at closing. There's a lot of moving parts to it, so we ask for at least a couple weeks to set that up.
Got it. Okay.
It's nothing that can be done same day like a normal 1031.
So let's just say that I call you, Kyle. Hey, man, I'm doing a reverse 1031. You guys take title in the interim. And man, the market's rough. I'm having a hard time selling. Just like we just went through a period of high interest rates, affordability being really difficult. Day 46 comes and I didn't get a sale. I didn't get a commitment. I didn't get a contract.
Yep.
Now what?
Theoretically, we would deed title back to the clients, but we don't really deed title depending on the state. Most of the times we'll just assign the LLC that we hold over the clients. And it's like they never did a 1031 because they're not selling anything. So there's not like a taxable event.
Okay.
It's just, they just own another property.
They just own another property. Yep. Okay. What is your service cost? Is this, what do the fees look like to do a 1031 through? I mean, you can't do a 1031 without you, right?
Yep, correct. Yeah. So that's one thing. I'm glad you brought that up because there's a lot of clients that think they can do their own 1031. They do their due diligence and they're like, oh, you need a third party to hold it. I won't hire a third party. I'll just direct escrow where to send the funds. That does not work. Clients always need a qualified intermediary for a 1031 exchange. It's well under $1,000 to do a normal 1031. A reverse exchange would start at like $5,000, $4,000 to $5,000 and go up from there depending on complexity, cost, stuff like that. So doing a normal 1031, a traditional 1031 is much more cost efficient. It doesn't always make sense.
Do you have any general rules of thumb of what's the breakover point to where you really should consider a 1031 versus just pay the tax on it, Yeah,
everyone looks at that. That's a really good question. Everyone looks at that differently because, you're paying, less than $1,000 to do a normal 1031 exchange, right? So some people say oh yeah, I'm only going to be deferring $5,000, but to me, it's still worth it because I'm going to buy another property anyway. But some people say I would just rather start with a new basis, pay taxes, and even if I'm saving a few $1,000 in taxes, it doesn't make a ton of sense for me. So we can't really tell clients what the break even is. It's that's something you want to discuss with a CPA.
Yeah, definitely. How many people, and I know that this is not advocating for your business per se, but we just went through this last cycle where I saw so many investors in a panic to exchange buy piles of crap that cost them so much money. Mm-hmm. And I guess how many times in your experience do you see people get into that frenzy and exchange into a long-term problem that just costs them money rather than just biting the bullet and, paying the tax?
So another really good question. I don't know. Clients generally don't call me back 5 years later and say, hey, you remember that exchange we did? That property didn't work out,
Yeah.
So I don't ever really hear a lot of the horror stories, but people will like refer me and say, talk to Kyle. He did an awesome job with my exchange a few years ago.
Yeah.
So I generally don't hear of problems if they were to occur because, again, we don't advise clients on what they need to purchase. So if they get underwater on something or it doesn't make sense, they're much more likely to talk to their broker and say, why were we looking at this or, something like that.
Yeah. Yeah. Last couple things I want to talk about here before we run out of time, just some creative things. I looked at your slide deck. We're going to speak at Pints and Properties tonight, the investor meetup. So if you guys are local in the area, don't forget, first Tuesday of the month, you just get a ton of free value in these rooms. But, you had one slide on there talking about, an inheritance. So like, let's say, somebody has a bunch of property and kids are squabbling and fighting over what happens when dad dies or whatever. You could exchange downward into like smaller properties that go to each individual child.
Yeah. So sometimes parents will put things in like revocable trust. So they pass on to each of the heirs and there's not really fighting. But the key part to remember with, when I hear the word inheritance is that, each spouse is passing on over $12 million worth of stuff to their heirs tax-free. So if the parents die today, it's like they may have $5 million in real estate, $3 million in stocks, and $1 million in Bitcoin. That's all going to the heirs tax-free.
Yeah.
And so a lot of people don't, it's called a step up in cost basis. So then like, Tim, say my parents died today and I inherited $8 million in property. I wish that was the case. Not that they died, but I wish I had $8 million in property to pass on. But say they were to do that, like I could turn around, even if they bought it for $1 million years ago, I could turn around and sell it tomorrow, and I'm probably taking a loss once you figure in commissions and excise tax and all that. So taxes die with you, which is something very powerful a lot of people don't know about.
Yeah, that's a good point. Can you tell us about the 95% rule and the 200% rule?
Yeah, so when we look at property identifications, there's rules. So you can't just identify all of King County and say, I'm going to buy one of these properties. When we talk about the 45 days to identify, some people say, why don't I just identify every property in Issaquah? Well, you can do that under the 95% rule, but the caveat is that you have to close on 95% of the value identified. Otherwise, the whole exchange fails.
Oh, got it. So that's why you need really like a specific property.
Correct. And most people use the 3 property rule, meaning they're going to identify up to 3 properties of any value to purchase because they're probably going to buy 1 or 2, maybe have a backup. But if that doesn't work, if they want to buy, a half dozen properties in Huntsville, Alabama, they're over the 3 property rule. So they go to the 200% rule, meaning they can identify any number of properties, but collectively they can't total more than 200% of what they sold for.
Okay. So you cannot, the total combined value of all the properties that you purchase in the exchange.
That you identify.
Oh, that you identify.
Can't total more than 200% if you're not using the 3 property rule. If you use a 3 property rule, you could identify 3 properties that are 500 million each.
Well, let's say that you sell and you identify 3, and next thing you know, your buddy brings you a portfolio for a screaming deal, and you want to exchange into that whole portfolio. That's like 20 properties, and it's like 500% of the value you sold for.
So if you're over 3 properties and over 200%, you'd go to the 95% rule, meaning you basically have to close on it. You can do that. You basically have to close on everything. Otherwise, the whole exchange fails. And it's taxed. So we see people do, and that's the exact scenario that we see people use the 95% rule. It's like, hey, I'm buying this portfolio of 30 rentals in Kansas City, Missouri. I'm either going to buy that whole portfolio or just walk away and pay the taxes.
Yeah. Okay, cool.
So there's a rule. The rules are super confusing for people, but I tell everyone, listen, just tell me what you want to do. There's a rule that will work for no matter what you're doing. Whether you're buying one property, whether you're buying a portfolio, there is a rule that will work for what you're doing. Awesome.
Well, this has been a super tactical episode. Sometimes we get philosophical. We talk about mindset. But I really like these. This is action steps. You left the audience with here's what you need to be thinking about. Here's action steps to get there. And just in the spirit of action steps, where can people find you, Kyle? How do they get a hold of you? Where do they find you? And where do they start?
Yeah. So our website is a really cool resource, velocity1031.com. They can call me. Should I leave my phone number?
Absolutely.
425-247-3307. All my socials like LinkedIn, Facebook, Instagram are just at Kyle Williams 1031. So feel free to connect. Check out our website. It's a great resource.
And for everybody listening, as always, Kyle's information is going to be organized in the show notes below. So scroll down to the bottom of the episode and give it a click. Check it out. His links will be clickable. So go to his website, send him a hello message. But yeah, man, it's been awesome to everybody listening in the Dynas world. I appreciate you. Hopefully you got some value out of this week's episode. We will catch you on the flip side. See you next week.